Success in speculation is not the result of random guesswork or sporadic flashes of genius. It is the direct consequence of the consistent daily application of sound, well-reasoned principles. The objective of this study is to provide a complete and logical method for the daily analysis and selection of setups for a breakout strategy. This entire methodology is predicated upon a single fundamental skill: the correct interpretation of the relationship between the volume of trading and the price spread. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. Before one can begin to identify specific market setups, it is an absolute prerequisite to achieve a thorough and practical understanding of the two indispensable tools of analysis. These tools are the volume of transactions and the price spread. All profitable operations in the stock market are based on a correct reading of the story that these two data points tell in conjunction. They are the words and sentences of the market's own language. The first of these tools is volume. On any price chart, the volume represents the total number of shares that have changed hands during a given period. But to the professional analyst, it represents something far more profound. Volume is the measure of the force, the power, or the effort that is being exerted in the market. It quantifies the intensity of the interest and the degree of activity among market participants. A period of low volume indicates apathy, a lack of significant interest from either buyers or sellers. It is a sign that the larger, more powerful financial interests are dormant or are content to let the market drift. A period of high or climactic volume, by contrast, is a sign of immense interest and activity. It is the footprint of the professional operator. A significant increase in volume is irrefutable evidence that a large amount of capital is being committed, and it almost always signifies the active participation of the most powerful and well-informed interests in the market. To analyze a price chart without a constant and careful reference to the corresponding volume is akin to watching the ocean's waves without any understanding of the powerful tides and currents that create them. The volume is the engine that drives all significant price movements. The second of these fundamental tools is the price spread. The spread is defined as the range between the highest and the lowest price achieved during a single trading period, represented visually by the length of a price bar. If volume is the measure of the effort or force applied to the market, then the price spread is the result that is achieved by that effort. It is the distance that the price was able to travel under the influence of the buying or selling pressure recorded in the volume. A wide price spread indicates that there was a decisive and clear victor in the battle between buyers and sellers for that period. It demonstrates an ease of movement, a lack of significant opposition to the dominant force. Conversely, a narrow price spread indicates a state of equilibrium, a closely fought battle between buyers and sellers where neither side could gain a significant advantage. A narrow spread is the evidence of struggle, or in some cases a simple lack of interest from either side. The key to all scientific chart analysis, as developed by Richard Wyckoff, lies in judging the relationship between these two elements. This is the great law of harmony and divergence. Harmony between effort and result is a sign of a healthy and sustainable price movement. For example, if we observe a sharp and material increase in volume, a great deal of effort, and it is accompanied by a wide price spread with the close near the high of the bar, a great and positive result, this is a state of harmony. It is powerful, confirmatory evidence that the demand is in control and is meeting little to no significant opposition from sellers. The market is healthy, and the upward trend is likely to continue. Divergence, however, is the more important signal for the professional analyst, for it is almost always a warning of a change in trend or a coming reversal. A divergence occurs when the effort and the result are out of sync. Let us consider the most common example. The market is in an uptrend, and a particular day sees a massive climactic surge in volume, the greatest effort seen in months. The amateur trader sees this volume and assumes it must be a sign of ultimate strength. but the professional analyst studies the result. He observes that on this day of immense effort, the price spread was actually very narrow, and the price closed only marginally higher than the previous day. This is a profound divergence. The great effort expended by the buyers failed to produce a significant upward result. Why? The only logical reason is that this tremendous buying effort was met by an equally tremendous and previously hidden supply of stock from professional sellers. The high volume represents the intensity of the battle, and the narrow spread proves that the battle ended in a stalemate. This divergence is a clear warning sign. It is the evidence of distribution, and it proves that the uptrend is in jeopardy. Learning to consistently identify these moments of harmony and divergence is the foundational skill upon which all successful daily analysis is built. To properly apply these tools, we must understand the context in which they operate. Who is creating these signals, and where on the market map are they operating? This requires an understanding of two more core Wyckoffian concepts. The first is the controlling force, which Wyckoff termed the composite operator. This is not a single individual, but rather a heuristic device, a mental model that allows the analyst to think of the market as if it were directed by a single, rational, and supremely intelligent entity. This composite operator represents the amalgamated activities of the largest and best-informed financial interests, the insiders, and the market makers. We study the chart to deduce the likely intentions of this composite operator. His objective is always the same: to conduct vast campaigns of accumulation, which is the process of buying large amounts of a stock from the public at low prices, and campaigns of distribution, which is the process of selling those same shares back to the public at high prices. The chart patterns we analyze are the footprints left behind by these great campaigns. These campaigns unfold across a predictable sequence of 4 market phases, which represent the playing field of our analysis. The first is accumulation, which is the basing or consolidation phase that occurs after a major downtrend. This is the period where the composite operator is absorbing supply and preparing the stock for a new advance. The second phase is the markup, which is the resulting uptrend itself, the period where both the composite operator and eventually the public are participating on the buy side. The third phase is distribution, which is the topping or consolidation phase that occurs after a major uptrend. It is the inverse of accumulation, a period where the composite operator is methodically selling his holdings to an optimistic public. The fourth and final phase is the markdown, which is the resulting downtrend. The daily setups for a breakout strategy that are the subject of this study are concerned with one specific and highly profitable objective: the process of identifying with a high degree of certainty the successful transition from the accumulation phase to the markup phase. Now that we are equipped with the fundamental principles of analysis, we will apply them to the daily, practical work of identifying and qualifying breakout setups. The process is a logical progression, moving from a broad market scan to the close monitoring of a select few candidates. It is a systematic funneling process designed to filter out ambiguity and isolate only those opportunities that present the clearest evidence of professional sponsorship. The first step in our daily routine is the scan, the purpose of which is to identify the formation of a potential cause for a future advance. Our work begins by searching for securities that have clearly terminated a prior downtrend and are now in the process of building a base of accumulation. This is the foundational work, and it requires a daily review of charts to locate the specific, evidence-based events that signal the end of a markdown phase and the beginning of a potential new campaign by the composite operator. The daily task is to scan a universe of stocks for the appearance of definitive stopping action. We are looking for the footprints of the composite operator as he first begins to absorb the selling pressure that has dominated the preceding trend. There are 2 primary events that we must learn to identify. The first is the selling climax. This is an event of dramatic proportions, representing the culmination of public fear. It is a day or a week of trading characterized by an extremely wide price spread to the downside, accompanied by climactic, often the highest volume seen in the entire decline. The key diagnostic evidence for the analyst is the close of the price bar. A true selling climax will almost always close significantly up from its absolute low, proving that the immense supply from a panicked public was met and overwhelmed by an even greater invisible demand from professional interests. The identification of a recent selling climax is the first piece of evidence that a stock is worthy of further study. Following the selling climax, the stock enters a trading range, and our daily analysis shifts to monitoring the process of absorption. Absorption is the quiet, methodical process whereby the composite operator absorbs any remaining floating supply of the stock within the newly established range. Our daily task is to observe the character of the price action as it tests the low point established by the selling climax. The proof of successful absorption is found in the diminishing of both volume and spread. As the price drifts down to test the support level, the analyst must observe that the volume on this test is substantially lower than it was during the selling climax. This lack of volume is definitive proof that the selling pressure is exhausted. Furthermore, the price spreads on these tests should become narrow, indicating that the downward momentum has dissipated. This combination of dwindling volume and narrowing spreads on tests of support is the primary evidence that the accumulation process is proceeding correctly. A stock that exhibits these characteristics is a prime candidate to be moved from a general scan to a focused watch list. The second step in our daily process is the monitoring of this select watch list. Once a stock has demonstrated the initial evidence of accumulation, it requires our close and patient attention. The daily task is to monitor these candidates for the appearance of the final, decisive test that typically marks the end of the accumulation phase and the immediate prelude to a breakout. This is the event that occurs in what Wyckoffian analysis terms Phase C. The key event we are watching for is the shakeout, also known as a spring. A shakeout is a deliberate and often sharp price move below the established support level of the trading range. Its strategic purpose is to mislead and remove the last of the weak-willed holders of the stock. It does this by creating the appearance of a renewed downtrend, which frightens the public into selling their shares and encourages premature short selling. The composite operator uses this manufactured fear as his final and best opportunity to acquire the remaining shares he desires at the most advantageous prices. Our daily job is to observe this event, not to become a victim of it. The proof of a successful shakeout lies in its aftermath. After the price breaks the support level, it fails to attract any significant follow-through selling. Instead, it quickly and decisively reverses and rallies back into the trading range. A correct analysis of the volume and spread during this reversal is critical. The rally back into the range should ideally occur on an expanding price spread and increasing volume, proving that demand is now in firm control. The successful completion of a shakeout is one of the most reliable indications that the entire supply of the stock has been absorbed and that the path of least resistance is now to the upside. Wyckoff's method provides a masterclass in the daily meticulous process of reading the tape. It's a deep forensic analysis of internal market action. However, it is essential to recognize that other market titans had entirely different daily routines for identifying major opportunities. Nicholas Darvas, for example, had a mechanical daily process of checking his boxes and adjusting his stops, regardless of volume. Richard Dennis and his turtles had a clear, non-discretionary daily task, checking if any market had made a new 20 or 55-day high or low. Bernard Baruch spent his days studying fundamental conditions and news, believing they were the ultimate cause of major trends. To provide you with a comprehensive education on these diverse but equally potent daily methodologies, we created our new channel, Trading Insights. It is dedicated to the practical strategies and success stories of these legendary speculators. To see how different masters approach their daily work, we invite you to subscribe and watch. The link is in the description. The third step in our daily routine is the transition to a state of readiness. This occurs when a stock from our watch list, having successfully completed its preparation, finally provides definitive evidence of its intention to begin a new uptrend. This is the event that moves a stock from a passive monitoring list to an active list of candidates for immediate execution. The key event that signals this readiness is the sign of strength. This is a decisive upward price move that is fundamentally different in character from any of the minor rallies that occurred within the trading range. A sign of strength, often referred to as a jump across the creek, is the action where the price decisively breaks out above the resistance level of the accumulation range. For this event to be considered a valid and actionable signal, it must be confirmed by a specific and powerful signature in the volume and the spread. The price spread on the breakout day must be wide and dynamic, with the close occurring at or very near the high of the session. This wide spread is the result, and it demonstrates an ease of movement that proves the absence of any significant overhead supply. This result must be accompanied by a clear and material expansion in volume. This high volume is the effort, and it is the irrefutable proof that large professional capital is sponsoring the move. This harmony between a powerful result, the wide spread, and a powerful effort, the high volume, is the final confirmation we require. It is the composite operator publicly declaring his intentions, and it is our signal to prepare for immediate action, pending only the final, low-risk entry point. The preparatory work is now complete. Through a consistent and disciplined daily process of scanning and monitoring, a trading candidate has been successfully identified. We have witnessed the successful termination of its prior downtrend, the long and methodical process of its accumulation, the final decisive shakeout, and the conclusive sign of strength. The setup has been fully qualified according to sound logical principles. We now transition from the phase of patient analysis to the phase of precise and professional execution. The daily work now shifts from observation to the active management of the trading campaign. The fourth step in our daily blueprint is the entry, and its entire focus is on engaging with the market at the point of minimum risk. A common and costly error among inexperienced traders is to act impulsively on the sign of strength itself. They see the price breaking out of its range, and driven by the fear of missing the move, they chase the price higher, buying at the peak of the initial excitement. This is a strategic error. An entry at this point is an entry at a moment of high volatility and maximum short-term risk, as the market is often vulnerable to an immediate pullback or reaction. The professional operator does not chase strength. He waits patiently for the market to present a secondary and far safer opportunity to act. This optimal point of entry is what Richard Wyckoff termed the last point of support, or in more descriptive language, the backup to the edge of the creek. This event is the first reaction or pullback that occurs after the initial breakout, the jump across the creek. The price, having successfully overcome the resistance of the trading range, will often drift back down to test this former ceiling to see if it will now serve as a new floor of support. This test is the professional's entry signal. It is the moment of greatest clarity and of the most logically defined risk. Our daily task upon seeing a valid sign of strength is not to act immediately, but to wait with disciplined patience for this specific event to unfold. The confirmation of a valid last point of support is found once again in a meticulous reading of the volume and the price spread. This is the final and most important masterclass. As the price pulls back to the breakout level, the analyst must demand to see two specific characteristics. First, the price spreads on the bars that form this reaction should be predominantly narrow. This indicates that the selling pressure is light, sporadic, and lacking in professional force. There is no aggressive desire to push the price lower. Second, and most critically, the volume on this pullback must be substantially and conspicuously lower than the volume seen during the breakout. This diminishing anemic volume is the final irrefutable proof that the supply has been exhausted. The sign of strength successfully absorbed the available sellers, and this low volume test proves that no significant selling pressure remains. This harmony of evidence, the price holding at a logical support level, the spreads narrowing, and the volume drying up completely, is the final confirmation that the path of least resistance is now clear to the upside. An entry at this juncture offers the highest probability of success with the most clearly defined and minimized risk. The fifth and final step in our daily process is the ongoing management of the position after the entry has been executed. The work of the analyst does not end once a trade is initiated. It simply enters a new phase. The daily task now is to monitor the health and progress of the subsequent markup phase, the uptrend, to ensure that the evidence continues to support the holding of the position. Our daily analysis of the chart is now focused on reading the character of the healthy trend. A markup phase that is under the control of strong professional demand has a distinct and recognizable rhythm in its price and volume action. The advances, or rallies, that make new highs should be characterized by expanding price spreads and a clear increase in volume. This demonstrates that the professional sponsorship is still present and that the demand is easily overcoming any profit-taking or minor selling. The reactions or corrections that punctuate the uptrend should, conversely, be characterized by a narrowing of the price spreads and a distinct decrease in volume. This low volume on corrections is the ongoing proof that the supply is not significant and that the majority of the stock remains in strong hands. As long as this harmonious rhythm of high-volume advances and low-volume pullbacks continues, the analyst has the evidence required to hold his position with confidence. The first sign of a potential change in trend would be a violation of this pattern: a rally on diminishing volume or a reaction on sharply increasing volume. To aid in the mechanical and unemotional management of the trade, we employ the trailing stop. A trailing stop is a stop-loss order that is methodically moved higher as the trend progresses. The correct Wyckoffian application of this tool is to, after each significant reaction and subsequent rally to a new high, raise the protective stop-loss order to a point just below the low of that most recent reaction. This technique serves a vital psychological purpose. It removes the emotional burden of having to guess where the final top of the trend will be. It prevents the fearful impulse to take profits too early on a minor dip, and it also prevents the greedy impulse of giving back too much of an open profit. The trailing stop allows the trend itself to dictate the exit. The position is held until the market's own uptrending structure is broken, and the stop is finally and logically executed. We have just laid out a complete daily blueprint for a breakout strategy. The intellectual engine that powers every step of this process is the correct application of Wyckoff's three fundamental laws: supply and demand, cause and effect, and effort versus result. To truly internalize this blueprint, one must grasp these laws at their theoretical core. Richard Wyckoff explained these principles not as abstract ideas, but through his own hard-won market experiences in his seminal work, How I Trade and Invest in Stocks and Bonds. For instance, he illustrates the catastrophic results of ignoring the evidence in his chapter on averaging down, and shows the power of correct analysis in his own successful campaigns. This book provides the foundational why behind the practical how we have discussed today. The link is in the description. In conclusion, we have outlined a complete 5-step blueprint for the daily work required to successfully trade a breakout strategy. This process is logical and sequential. Step 1 is the daily scan to identify the formation of a cause. Step 2 is the daily monitoring of a watch list to await the final test. Step 3 is the recognition of the sign of strength that signals a state of readiness. Step 4 is the patient execution of an entry at the point of minimum risk, the last point of support. And Step 5 is the disciplined daily management of the position as the new trend unfolds. The successful trading of breakouts is not, and can never be, an impulsive or haphazard affair. It is a daily, disciplined routine of evidence gathering. Its success is predicated entirely on the ability of the analyst to correctly read the story being told by the market itself through the language of volume and price spread. The results you achieve in the market will be a direct reflection of the quality and consistency of your daily preparatory work. The steadfast application of this scientific approach, as laid out by Richard Wyckoff, is the only reliable path to achieving consistent and lasting success in the field of speculation.